Hello, everybody. So I just wanted to start today's trading day with a commentary about yesterday, because yesterday my top two stocks were doing wonderful, with Enphase up 16.3% and Tesla up 6%. And of course, the reason for that was the interest rates. This is literally a single issue market. I don't believe either of those stocks should have been down this much in the first place. Yes, that includes Tesla. Tesla, in my view, when I do my valuation for Tesla, is much higher than $237. I don't think they should have gone down this much in the first place, but that's because we live in a single issue market. The only thing the market cares about is interest rates, because the market, Mr. Market, he's so short term and he only cares about the short term. But this is a preview, I believe, of what will happen once the interest rates drop, once the Fed eases interest rate, which they have to. I'll conclude this video telling you why they have no choice. They have to. So if you look at what happened today, to understand kind of the chain of events, so the CPI was released, and CPI was flat in October from the prior month. And the core CPI was at 2-year low. Of course, the core CPI is what the Fed looks like. And of course, because the CPI was good, people are assuming that the Fed's going to drop rates, right? It's like reading into Jay Powell's mind. Oh, the CPI is good, so the Fed's going to drop rate. And therefore, if the Fed drops rate, well, what happens? Well, that means the future is back. That means these stocks, to which we have illusions as to how the business work, right? Because we believe in single issue interest rates. Mr. Market believes in only one issue, interest rates, right? They believe that you buy a house because of interest rates. That's the only reason you buy a house. You don't buy a house to put your family in it, right? You buy a car only for interest rates, right? You don't buy a car because you need transportation, right? That's the issue with classical economics. That's the issue with having someone deciding the cost of money and having all of this short-termism. The truth is very different. The truth is, you buy solar because you need to cut down your costs. You buy a car because you need a car. You buy a house because you need a car. Nonetheless, I'm going to be on a rant here. Nonetheless, this short-term market loves to see lower interest rates. And so what has happened is what? If you look at the CME watch tool, which we're all very familiar with right now, which are the odds of drop, we see that the odds of the first interest rate decline is now for May. People are saying May of 2024, so that has moved up by 1 month, May. And if we get good reports, who knows? Maybe in March, maybe interest rates will be cut at the March meeting. Who knows? There's 32% chance right now of a March meeting, and this deadline for interest rate dropping has already moved up 1 month. And so this is very positive news for Mr. Market, who is all about the short term. And of course, when interest rates go down, well, Mr. Market can be just a tad less short term, and see opportunities like solar energy, see opportunities like Tesla, see all sorts of other long-term opportunities. And what I want to say is, yeah, I was very glad that Mr. Market overreacted and we got these prices. Like, I was happy to stack Enphase in the $70 range. I know someone in the comments section is waiting for $30. I don't know if it will go down to $30. I mean, I don't know. It's like me, I focus on having the right position and having the position that I want to have. And to me, the right position for Enphase is the second biggest position in the portfolio. And so obviously this was a great opportunity to add more stocks, because energy underlies everything we do. And I believe Enphase is the decentralization of residential energy. Anyways, I've covered Enphase so much on the channel. Don't need to spend much time talking about Enphase. Tesla, of course, is also a major energy play. And I was happy to buy some Tesla. Right, we got Tesla at 197 for Tesla. I remember making a buy at 197. All of this reduced my cost basis for Enphase. I'm still in the red, of course, for Enphase, but it's not about that for me. It's about having the right position. Tesla, buying Tesla at 197 increased my cost basis, but I believe 197 is nothing like what we are going to have in the future as far as the value of a company. So as the rates go down, to go back on this little macro topic, as the rates go down, the market ascribes a value to the future. The market can look a little further out than 1 quarter when rates go down. And don't get your hopes up. The market's never going to look 10 years out. That doesn't happen. In fact, many more modern MBAs do even a 5-year discounted cash flow, not even a 10-year discounted cash flow. They've always done a 10-year, which is crazy that you don't look at cash flow past 10 years. But think about that. They do a 5-year discounted cash flow. So the only point that I'm trying to say here is that the market looks further out on the horizon when interest rates go down. And in the market's narrative, because this is all about the understanding the narrative, right? Because in classical economics, Keynesian economics, you believe interest rates impact everything. Interest rates are high, I'm not going to do this thing. And so the market narrative is people are not going to do solar because of interest rate, right? Things like energy independence, things like the cheapest energy, that doesn't really matter. People just think about interest rates. Same for electric cars. But electric cars, solar, these products that have to be financed become instantly more compelling when interest rates go down, like the 10-year right now is going down. And of course, Mr. Market loves things that are instant. And so that's why these stocks are going up, plus 16%. I mean, for Enphase, these short-term price movements make so little sense. You have a stock with no stock-specific news. That's up 16% at the end of the day compared to the beginning of the day. And there's no stock-specific news. Anyways, real estate might make a comeback too. Of course, many people, since I've been following Open Door, many people in the comment section, would have bet a long time ago that this stock would already be bankrupt. No, it's not. When I look at the numbers, it's not going to go bankrupt, and the stock is back up, and we'll see. We'll go back to the 4, to the 5. Likely in my view. It looks like people are going to buy houses again. Well, that was entirely dismissed by the news and the market, but it looks like, very positive article about mortgage rates headed down. Analysts at CNBC, chief economist for the National Association of Realtors, saying, 7% in a few months, maybe 6% range by 2024. So it looks like, 2024, that's just around the corner, by the way, spring of 2024. Just around the corner, right? A little more than 2 months at 6%. So, it looks like people are going to buy houses again, right? They would have bought houses anyways. If rates had been 8%, they would have bought houses at 8%. That's it. But anyways, so it looks like real estate's not dead after all. And I'll conclude with this. And this is more for macro videos. My macro videos tend to not be watched. But, the reason why this channel is named Beat the Denominator is because I believe denominator growth is the only constant. By denominator growth, I mean debasement. Monetary debasement is the only constant. As governments, zombie companies need to refinance their debt. No, they don't need to refinance their debt. They could go bankrupt. But modern society has no desire for bankruptcies, no desire for spending cuts of any kind, no desire for millions of people losing their jobs and their homes. There is no desire for, what Ray Dalio calls a deleveraging. That desire was still there in the late 1800s, early 1900s. In the 1900s, that desire, 1930s, that desire for deleveraging was there. The general population, their desire to save the money was there, but this desire is not there anymore, right? Of course, the government does not have to get a 3 trillion, probably 3 trillion of treasuries next year that they're going to have to spend. Of course, that's the deficit. That's a 3 trillion deficit. Of course, the government does not have to issue $3 trillion in deficit in the form of treasuries. They don't have to do that, but they also have to cut everything. They would have to triple taxes and cut every single discretionary spending, right? No more government anything. And then you triple your taxes, and then maybe you get away with not having to issue treasuries. And governments don't want to do that. They don't want to shut down everything. No more no more social safety net, no more anything, right? Austerity. This is something that you see around the world. No governments want austerity anymore, right? And this is the same is true from local governments. The same is true. There is no desire for deleveraging in society, right? If you look at the numbers are scary of so many companies out there that are zombie companies that only exist because they can refinance their debt. Right? And if they can't refinance their debt, they go out of business. Well, the Fed has to be looking at that and say, well, wait a minute. We're going to have a lot of social turmoil if rates are not zero. Because if rates are not at zero, these companies with 100 billion, 150 billion of debt, I'm thinking about, big utility-style businesses, these companies are going to go out of business. Right? The Fed is looking at that, and then that creates a lot of turmoil. That creates a lot of tremendous social turmoil. So zombie companies, we don't have a general desire from the government to see zombie companies go out of business. And we have well over 20% of the public companies that are zombie companies. So that's why rates have to go back down. Because, of course, when rates go back down, you have companies that are zombie companies at 8% rates, and they're doing fine at 1% rates. Right? So that's the key. That's the key. Modern societies prefer the 1,000 cuts of monetary inflation, right? Of hidden, hard to notice 2% inflation. That is what modern societies prefer to see. And it's not even guaranteed we're going to see that inflation, because what you see is that in the system, because of technology, you have a lot of tremendous deflation, because productivity in our companies, technology is moving so fast and collapsing the costs of what used to be major expenses for businesses so fast. These costs are collapsing that it's entirely possible that we actually see deflation, and that would create a whole host of problems again for monetary policy and for GDP and for GDP growth. That would be one of the main issues, but that would be good for society. So societies prefer the soft way out of the problems, not the hard way. And this is why I fundamentally believe that rates will go down. And when rates go down, of course, we live in a fractional reserve banking world. So when rates go down in a fractional reserve banking world, that means that more people want to get debt, and so more money is created by the commercial banking system. And this is what you end up. This is what started the channel. Right, you have M2 money stock. M2 money stock is roughly flat right now, roughly more or less, which is appalling when you see the crisis that the Fed has created. It's appalling to see money supply actually only flat right now on an M2 basis. But of course, we don't know much about the euro dollars. We don't know much about how many euro dollars are out there. But monetary inspection, this is your denominator. Everything you value, every stock you own is divided by the number of dollars out there. And the number of dollars out there are getting diluted. In my view, to the best of my abilities, the dilution is about 15%. We are seeing about 15% dilution in the value of the US dollar, because, if you have your salary, for example, your salary is a percentage of the total money stock, right? A 0.0000000x% of the total money stock. Your salary as a percentage of the money stock is decreasing every year by 15% if you express your wealth as a percentage of the money stock, right? And this is monetary inflation for you. And the way I compare this to is it's just like you have a fine wine, and then you add water to your wine, and you keep adding water to your wine. And in the case of 15% per year for 10 years, that's a 3x dilution, right? So 3x dilution is you try to dilute your wine with 3 times more water. Wine won't taste as good, will it? It will not taste as good. Well, the same, in my view, is true for the dollar, right? A $20 bill does not, quote unquote, taste as good today as it did 10 years ago, and it will taste way worse 10 years from now, as this is the way that societies have chosen to go about the issue of debt because there is no desire for deleveraging anymore. And in my view, this Fed thing, these interest rates so high, it's always been a bluff. It has been a bluff to shock the system. It's all about jawboning and making sure, I'm going to keep interest rates high. And the market's short term, so the market doesn't really spend much time studying the rest, and they believe the bluff to shock the system and to push a recession. But when you look under the hood and when you look at the facts, to me, it's very obvious that interest rates are going to go down and that deleveraging is coming. So anyways, a bit more of a macro video today. This is not investment advice. This is just entertainment. Thank you so much for watching. Please like, please subscribe, and have a wonderful day.